Well, good evening, everybody. My name is Mark Zeide. I'm the Executive Director of Wismed Financial. Thank you for joining me this evening. We're going to be talking about year-end tax planning, and specifically a couple of the items that you can expect from tonight. First is when to pay your property taxes. It makes a big deal this year. We're going to go over the proposed tax law changes that are working their way through Congress right now, and also talk about some charitable giving strategies and other tax provisions that may be changing. So why don't we get started? So here are the tax brackets, and you can download this from wismedfinancial.org/resources. What you see down the left side of the page here, these are the brackets from 10, 12, 22, and so forth, all the way up to 37%. Now, one of the things that people think is that, well, gosh, if I have $330,000 of income and I am married filing a joint tax return with my spouse, that gosh, I just bumped into the 32% bracket and now all of my income is being taxed at 32%. And that's just simply not how the tax rules work. So it's really only that last $150 that's taxed at 32%. All of your income up to that point is taxed at its various brackets. So there's a portion of income being taxed at 10%, a portion from $19,900 up to $81,050 that's being taxed at 12%, and so forth. So it's really only those last few dollars that are being taxed at that higher rate. Now here is the changes that are being proposed in Washington right now. And so whether it's called the Build Back Better plan or American Families Plan, I've seen it described in both of those terms. Here are the changes, and specifically at those higher income levels. So one of the first things that happen is that taxpayers get through the 35% tax bracket quicker. In other words, they jump to that higher bracket because the 35% bracket is now compressed. And that 37% bracket has now jumped up to 39.6. And of course, because we're in Wisconsin, don't forget we've got Wisconsin income taxes on top of that. So that's typically 6.27% or 7.65% for high income earners here in Wisconsin, in addition to those taxes that we're paying to the federal government. So if you grab your 1040 from last year, here's where you can see some of those key figures. So let's start on line 15 of your 1040. So that's your taxable income, but that's a combination of both your income taxes and your capital gains taxes. So from line 15, let's subtract line 3A and line 7. Those figures are taxed at the capital gain rate. So if you subtract those from line 15, what you'll end up with is your ordinary income. And that's what you can really apply to those ordinary income tax brackets that we saw on this previous slide. Capital gains are the other tax rates that we should be aware of. And so that's generally 15 or 20% for most taxpayers. And there's an additional 3.8% that kicks in for folks that are considered higher income. Higher income for capital gains rates is a threshold of $200,000 for singles, $250,000 if you are married. Now those tax rates are also subject to change here based on the proposals going through Congress right now. So that first change is that anything over 400 single or 450 married filing joint is now going to be pushed into that highest capital gain tax rate, and that highest capital gain tax rate is now jumping up to 25%. Now keep in mind, we have to add in the other additional 3.8% on top of that, plus Wisconsin. So effectively that capital gain tax rate starts to add up, which is one of the reasons why most people, once they have some of those unrealized capital gains, where they never want to sell those investments because the tax burden to selling it at times can become too great. So again, go back to your tax return, and where you can see those figures on here is line 3A and line 7. Those are the capital gain figures that would be used, and again, either 15, 20, or if Congress passes the new rules, perhaps 25% plus that additional 3.8% kicker on top of it. Now, one of the things that we can look at are where is the income coming from that's hitting your tax return. And so income all adds up to line 11. That's adjusted gross income. And that's before you take any deductions, either the standard deduction or itemized deduction, to come up with taxable income. So taxable income is what you actually pay taxes on. Adjusted gross income is really just the sum of all of your income. So let's look for some ways that we can control taxable income. And so there's a few of them. So income taxes, or ordinary income, is made up by your paycheck or wages, bond interest, real estate dividends, and so forth. Then we've got the capital gains right here in the middle, and then municipal bond interest is tax-free. So one thing that we can look at is how to minimize or shift some of those income sources. And so line 2B and 3B on your tax return really shows the interest and the dividends that you are paying taxes on each and every year. And so one consideration would be to look at the investments that are generating that taxable interest and those ordinary dividends. And so those investments right now, if they're showing up in your 1040, they are in a taxable investment account, a non-retirement account. And that's why you're seeing those show up on your tax return each year. So one consideration would be, well, can we shift those investments from being owned inside of a taxable account to having them owned inside of a tax deferred account and getting them off of your tax return each year? So that might be one consideration. Now, we have to keep in mind that in doing that, it might require you to sell that investment and repurchase it in the tax deferred account, which means potentially realizing some capital gains in the process. So I have to be a little bit careful about that, but that's one way that we can perhaps control some of that that income that's hitting the tax return each year. I'm going to add this in here as well, especially for those of you who are age 65 or older on Medicare. The more income that you have, the potentially more that you pay in Medicare premiums. And so this is another reason why it can be really important and really beneficial to control the amount of income that shows up on your tax return each year, because your Medicare premiums are based on the last tax return that the IRS and Medicare has on file for you. And again, as your income goes up on your tax return, so do those Medicare premiums. Now there are really three other ways to control your taxable income. And so there are deductions, credits, and deferrals. Deferrals is the easy one. So if you have a 401k or a 403b, you defer income into that plan on a pre-tax basis, meaning you don't pay income taxes on that income today. But when you take that money out in the future, that's when you'll owe some income taxes on those withdrawals in the future. Credits reduce your tax bill, and generally you'll qualify for these, or in many cases you may not, based on higher income and phase outs there. So that'll be available on the tax return, but we're going to focus a lot of time today on deductions. And this is how you can reduce the income that is being taxed to begin with. So for most folks, that means filing Schedule A with their tax return. That's where we record our itemized deductions. And you have the ability to claim either the standard deduction or the itemized deduction, whichever one gives you the better tax benefit. And so what you see on the bottom of this page, and I believe this is on the top right corner of that tax table that you may have downloaded from the website. So married filing joint this year, the standard deduction is $25,100. If you're over age 65, you get an additional kicker of $1,350 per person who's over age 65. So $2,700 kicker for those of you who are married, and both of you over age 65. Now there are 4 different categories of itemized deductions. And again, itemized deductions only are beneficial if they exceed that standard deduction. And so those 4 categories are medical and dental expenses, taxes that you pay, mortgage interest, and then gifts to charity. And over the past number of years, most people are claiming the standard deduction. First, because it's been increased as a result of the Tax Cut and Jobs Act that went into effect, I believe it was in 2017. The other reason why is because of this taxes you paid category. And the acronym here is SALT, S-A-L-T. It stands for state and local taxes. And historically, that's been capped at a maximum of $10,000. And so for people that are paying property taxes, Wisconsin income taxes, those are both components of SALT. They haven't been able to take full advantage of those taxes that they're paying because they're getting capped at that $10,000. Well, one of the proposals that's part of the, that's working its way through Washington right now is to actually increase that SALT deduction from being capped at $10,000 to perhaps as high as $80,000 that I've seen in one particular proposal. And so what that means for most people is that when you pay your property taxes now makes a really big difference. So for most physicians, especially if you're working right now, you're probably already paying at least $10,000 in Wisconsin income taxes. And so if you pay your property taxes, it doesn't do you any good from a tax perspective because you're already capped at a maximum of $10,000 for state and local taxes, for SALT this year. However, if that SALT is increased next year, now paying your property taxes in 2022, now you're able to take that property tax payment as a deduction on your tax return. So for many people, it may make sense to make those property tax payments after January 1st. Now the other item that's on here is gifts to charity. And here again, this might be, you may want to postpone your charitable gifts if you're making year-end gifts to charity. It may make sense to postpone those until after January 1st. So it may not be a year-end gift this year. It might be a beginning of year gift for 2022. But here's why how the math works out on that. So let's say that you in 2021 here, let's say you are capped at a $10,000 state and local tax for Wisconsin income taxes and property taxes. You've got some mortgage interest and you make a charitable gift. Well, that's $20,000. Obviously, it's less than the standard deduction, so it doesn't do you any good. That charitable gift doesn't do you any good this year. But let's fast forward to next year. So if that state and local taxes is increased next year, it may look more like this. Now we've got a $32,000 SALT deduction. So again, property taxes, Wisconsin income taxes, mortgage interest. And now that charitable gift does help you out, as well as the property taxes helps you out in 2022. So we've got a $42,000 itemized deduction for 2022 versus the standard deduction. So again, if SALT is increased next year, most likely pay your property taxes after January 1st, give to charity after January 1st. Now, if SALT is not changed, you may want to pay at least $2,500 of your property taxes this year. And the reason why is it's not for your federal taxes, but on your Wisconsin income tax return, you get a maximum of $300 Wisconsin tax credit for paying at least $2,500 worth of property taxes. So again, if SALT is not changed. The other thing you can do if SALT is not changed is to start to bunch together your charitable gifts. And so that's what you see in this far right column here. So again, let's do this exact same thing as before, $10,000 SALT, mortgage interest, $5,000 gift to charity this year, but then let's take the next 4 years worth of charitable gifts, $5,000 a piece, and let's deduct those this year. So we're going to bunch those charitable gifts into 2021. Now we've got an itemized deduction of $40,000 for this year. Obviously that's over the standard, and now that charitable gift is beneficial for us. Over 5 years, here's how the math works out. So 5 years worth of standard deductions is $125,000 and change. 5 years by bunching the charitable gifts into this year results in $140,400 of deductions over that 5-year period. And so this is, you'll notice, is particular for folks that are under age 70 and a half to do this. And the way to bunch charitable deductions is through something called a donor advised fund. It's simply a charitable account. And by putting money into that charitable account this year, that triggers a tax deduction for this year. And here's how the math works out on that. And this, on the last example, it's worth about $4,500 to bunch those charitable gifts. And all you're doing is you're making the same charitable gifts that you normally would, but you're claiming the tax deduction in the year where it can be beneficial. So here's an illustration of how that donor advised fund works. We're going to take cash or if you have it, appreciated investments that are not in a retirement account. We're going to use that to fund that charitable account or that donor advised fund. And then for this year, next year, the year after that, you're going to use the donor advised fund to make your normal charitable gifts like you normally would. And that's how you can claim the tax deduction for those charitable gifts now by bunching them together, but then distribute that money over time to your favorite charity of choice. Now, if you're over age 70 and a half, the charitable strategy is a little bit different. You should be using what's called a qualified charitable distribution. And that's a distribution from your pre-tax retirement account that goes directly to charity. So the difference there is that normally distributions from your retirement account show up on your tax return as part of your adjusted gross income. However, by using that QCD strategy, the money goes from the retirement account directly to charity, and it never shows up on the tax return to begin with. So we're reducing your adjusted gross income after we subtract either itemized or standard deduction. There's simply less taxable income in the end. Therefore, it's effectively, in this case, 24% federal bracket and 6.27 Wisconsin, saving $1,500 by making that charitable gift the right way through that QCD or qualified charitable distribution. All right, finally, let's talk about one of my favorite tax strategies, the Backdoor Roth IRA. And so the way that it normally works is people that have high income can't contribute directly to a Roth IRA. Therefore, they put money into a traditional IRA first and then convert it into the Roth IRA. And they get the same result as if they were able to contribute to a Roth IRA to begin with. Now, this is one of those areas that's up for debate in Washington. As of September 13th, Congress had effectively eliminated the ability to convert after-tax dollars, and so it effectively killed the Backdoor Roth IRA. Since then, however, November 3rd, there was a change in the proposed legislation, and Backdoor Roth IRA was back in. So we're just going to have to wait and see what actually gets passed by the legislators to know what we can do with the Backdoor Roth IRA going forward. My best advice to you is for 2021, you can definitely still do the Backdoor Roth IRA, and it would be beneficial to do that by December 31st. Now, technically, you have until April 15th of next year to make your IRA contribution. However, if those proposed changes go through, we're going to need to have the Backdoor Roth IRA done by 12/31 instead of waiting until April 15th of next year to do that. Now, the other change that is being proposed is a limitation on Roth conversions for high-income folks. Now, this takes effect in 2032, so there's a 10-year delay on this. The way that the Roth conversion works, the green on this graph represents taxable income. The lines going across horizontally represent the various tax brackets. And so this is something that I see all the time where we have, while you're working, taxable income is high, one spouse retires, the other spouse retires, and now all of a sudden you're in a fairly low tax bracket from retirement until you see here's at age 72, the taxable income jumps up again. And that's because at age 72, you have to take required minimum distributions, which come out of those pre-tax accounts that you've been deferring all that time. So really, from retirement until age 72 is some key tax planning years. And one of the strategies that's often used is to do a Roth conversion in those years. In other words, let's fill up and utilize those low tax brackets. and do that with some of the money that you've been tax deferring in 401k, 403b, IRA all these years. So pay some taxes, but now we're paying it at the lowest tax rate that you may ever see in your lifetime. And you can see it can add up to significant amounts of tax savings by doing that. Now, again, this is one of those proposals that's out in Washington right now. After 2032, they would eliminate the ability for people to do a Roth conversion if you're over that $400,000 single or $450,000 married, what they're calling adjusted taxable income. So why doesn't it take effect until 2032? Well, you have to follow the money on this one. So one of the things that the Congress is trying to do is how to pay for this tax bill that they're trying to pass. And one of the ways that they're trying to pay for it is by generating tax revenue. And so if you tell high income folks that after 2032, they're not going to be able to do Roth conversions, well, that's going to motivate them to potentially do Roth conversions between now and 2032, thus generating taxes for the federal government and paying for this bill that they're debating in Washington right now. So kind of an interesting little nugget regarding the, why this is not taking effect until 2032. So with that, I'd like to thank you for joining me this evening. And if you do have any questions, feel free to enter them in the chat or come off of mute, and I'd be happy to answer those. Otherwise, I really do appreciate you joining me this evening. Please contact me with any questions, and have a good night. Thank you.